Welcome back. I'm very pleased to have you back. Also, I'm very pleased to have Seamus Donoghue with us now, I hope. And he'll hold a presentation on the key to unlock the digital asset markets. Enjoy. Seamus?
Hi there. Thanks very much, Robert. Thanks for having me again back this year to the CAC21. And today, as mentioned, we'll talk about orchestration, what that means, and why we say it is the key to digital asset management. So quick introduction. Obviously, I'm Seamus Donoghue. I'm the VP of Strategic Alliances at Metaco. And about Metaco, we are a Swiss-based company from the French side of Switzerland, Lausanne. We've been around since 2015. Our genus very much is the institutional side of this market. We had a panel yesterday talking about the institutionalization of crypto assets and the market more broadly. And that's been very much our genus. So our most recent round of financing was also led by a German entity you might be familiar with, CAC21A Devrient. They are a German securities company, technology company, also a very active supplier in the central banking space. They invented the SIM card, print the banknotes for the Bundesbank using the inks of one of our other investors, SICPA, which provides security materials for banknotes to every central bank, barring those that are on sanction lists. But our investor base is very much our strategic partnerships as well. So here's a sample of some of our clients in the market. I think the one thing to observe is that we work with most, let's say, bank use cases, from private bank to crypto native bank to universal banks to security services banks and infrastructure providers to those banks. It's notable that I think NYDIG made an announcement a week ago that FIS would be the first core banking provider with an integration to a custody solution. In fact, I think our integration with Avaloq predates that. We've had a full integration to Avaloq's core banking system. So since 2018, so only there are 150 private banks, among other banks, have a turnkey solution that's completely abstracted behind the core banking solution. Our success has really been in jurisdictions where the regulators have given a clear roadmap to the banks, both from a taxonomy, a licensing regime, and kind of a roadmap to how the banks can build in this space. BaFin has been a leader in that space, and we see that now reflected with most of the major banks in Germany building capabilities and building capacity. And as we said yesterday, in institutional adoption, that's a key requirement for the build out of the space. And I think as we start this discussion about institutional infrastructure and orchestration, I think it's important to dispel a myth that basically it's been a rough ride the past few weeks, or let's say that in the month of May, but it's important to keep that in context. We were talking about an asset class that has 100 plus annualized vol. 30 to 70% drawdown is not pretty, but it should be expected with that kind of type of vol. And the main perspective here is that we continue to outperform every other major asset class. So I would expect that to continue even if we do see further retracements here. But I think the main point is institutions are building, and we showed a version of this chart last year, and it's really about the Gartner hype cycle. And we don't need to get into the bubble period, 2017, the collapse, the winter, the trough of disillusionment. I think the point is we're out of those stages now. We've gone past the pioneering stage where some of our early clients really built a business case. They built in this infrastructure without a business case. They had the inclination or the intuition that this was relevant, would be something. We've moved past that 2018, 2020 period. Last year was really about kind of the initial signs that there was a business case. Institutions could build articulate a proposition to their boards and build an offering to their clients. And that what we're seeing now let me move that out of the way. What we're seeing now in 2021 is really that adoption broadening, whether it's corporate balance sheets, asset managers of all types, basically traditional versus, let's say, hedge fund space, life insurance companies, and traditional incumbent banks, investment banks, and payment rails are all looking to offer on this, and they are monetizing this. I think the notable point is basically you're seeing impact on balance sheets and bottom lines from all of those that have launched businesses in the space. And I think when we look at this same sort of diagram next year, that portion of the mainstream adoption on the right will dwarf any sort of list we've had prior to that, because we're seeing adoption on a weekly basis here. Now, what are they actually building? I think the focus has been really around crypto assets, let's say narrowly defined as cryptocurrencies, and the structures you can build in that, whether they're DAOs or DeFi protocols. It's an exciting and fast-growing asset class. We're talking about a space that's somewhere between 1.5 and $2 trillion, depending on the week. But the traditional securities, the traditional, let's say, assets, the world as we know it, eventually will be tokenized, and I think that space is really where most of our clients and most firms that are building really see the future. So you build infrastructure for DeFi, it gives you a free option on, let's say, the broader tokenization initiative, whether it's tokenizing payments, which we spoke about yesterday, tokenizing securities. You can think about bond markets. They alone are $110, $120, $130 trillion global opportunity. And given the expansion in global balance sheets expanding rapidly, equities are somewhere in the order of 40 trillion. And there's a whole new range of other assets that are currently unbankable that we could see transformed into bankable assets through tokenization. So this is very early times, and the opportunity is a huge one. Building for crypto gives you the optionality in the DeFi space. Now, over time, what we've observed basically is a lot of firms, whether they're crypto natives or digitally natives, building this space. They start with their own vault. The early adopters built their own infrastructure. They added other vendors. Now, what we see, the reason they added other vendors is in the crypto native space, agility and speed is critical. This is an exponentially growing, rapidly evolving asset class. And to be nimble, to add new currencies, new features, we've often seen many of the let's say, the native firms in this space, they start with their own, but quickly decide that to be more agile, they add a third-party vendor solution, and then they end up with multiple vendor solutions. This obviously increases complexity. As you add more and more vendors, how do you manage each of them have to have their own policy engine, their own sort of accounting layer? How do you manage all these different infrastructures? What do you integrate them to? Do you have a core infrastructure? Do you have a front end that manages all these different sort of backends, let's say, whether they're self-custody infrastructure, even trading applications, staking applications? It becomes very complex very soon, and you end up with what we have in the legacy space, a bit of a spaghetti system. Risk and control sort of gaps because you're managing multiple front ends respectively from those front ends. So in the traditional space, we see a similar evolution. As mentioned, we have security services firms we're working with now. They come from a slightly different background, but have the same potential use case to start with. They potentially have multiple self-custody frameworks. Now, we've spoken about the reason to be agile, but there's obviously not all custody is the same. You have hot, cold, hardware-based MPC. You need to support those. Regulated firms may operate in multiple jurisdictions where they have very prescriptive rules. So again, they may work with our solution, they may work with their own solution, they may work with third-party solutions. They end up with multiple self-custody solutions they need to orchestrate and manage. Expand that into the security services. So security services works on direct custody, which is self-custody. And then they have this network, typically called network management, which is a network of sub-custodians for jurisdictions where they're not licensed, they do not operate, and they need to rely on a network of sub-custodians. In that space, what we observe basically is some of the larger security services firms may have upward of 100 sub-custody relationships. Now imagine each of those comes with different sort of risk and control policy frameworks, as do the self-custody frameworks. They have different data accounting frameworks. Particularly from a regulated institution, when you go to your regulator and say, we have all these discrete systems we need to manage, it's a huge regulatory gap, it's a huge control gap. And not to mention, at a minimum, it's very complex to manage. It's very hard to scale. Your operations are highly complex. And what do you integrate these systems to? The difficulty with legacy banks is they already operate multiple technologies, multiple core infrastructures, and it means multiple very heavy lifting in terms of integration. You don't want to integrate to a core infrastructure in a bank many times. Once is enough. You do it more times, it's going to be a massive roadblock because in the end, they have a morass of different legacy systems they're already built on. We speak to one major bank that has 14,000 different infrastructures. Obviously, you don't need to integrate all of those, but it just gives a sign that it's not necessarily holistic infrastructure. So, and what we also need to think about is, diversification simply for vendor risk. And we're seeing this as a theme from everybody we speak to now. We've had a recent acquisition by one of the competitors in the custody space. And it makes firm realize that whatever you rely on, you should have more than one of it. Basically, you need some diversification. So I think the one key point here is we see firms build their own vaults. They use sub-custodians. They use vendors. They struggle to integrate. It ends up in a bit of a mess. And in the end, this space is also evolving very quickly. The digital asset market, especially the custody part, is multi-layered, complex. It carries risks, trade-offs, particularly with regard to agility and security, and assets are moving exponentially more and more across every direction in this space. So what we've put together, what we've launched is a solution called Metaco Harmonize. This is in production with our largest clients. It's designed explicitly with them, with the particular use case around security services. And what it is a single point of integration for a bank or for a digital native firm to manage all your backends. And what does it deliver? It's really a single orchestration layer, which we talk about in the context of a single holistic policy layer, a single accounting layer, a single position keeping, the ability to manage multi-tenants with that, the ability to have single core connectors to other critical services, whether it's AML providers like Elliptic, your choice of settlement networks, one or more, reporting tools like cutting NAVs, doing fund accounting. Now, importantly, we deliver some critical components of that. So we have a harmonized layer, which is your overall orchestration layer. Metaco Vaults, I think some of you may know our former brand, which is Silo, which is really a self-custody infrastructure. I think early on, we realized that self-custody or custody is not one size fits all. It's basically, there's need for hardware-based, there's need for different hardware providers, there's MPC-based. Clients may have use cases for one or more of these. So our own, we still provide a wallet solution, which is highly scalable, designed for large institutions. Comes with an advanced sort of policy framework and the ability to manage both permissioned and public ledger assets. But importantly, we realize that not every client is going to use our vaults. They may need our vaults, they may not. They may have multiple third-party vaults. So this Metaco Vaults is now much more of a holistic notion that whatever your third party or whatever your self-custody infrastructure is, you can integrate it to harmonize and manage multiple self-custody frameworks. Now, of course, sub-custody is increasingly a need for both basically asset managers coming in this space. They will not rely on self-custody. They need to externalize that to a third-party provider. And as I mentioned earlier, in the security services space, there's a notion of sub-custody. And you want to diversify across multiple sub-custodians for diversification reasons, for feature reasons, as you would for self-custody, and as well for managing networks for jurisdictions where you don't operate under a regulatory umbrella. You can rely on a third party. Well, each of these services, whether it's self-custody or sub-custody, so Metaco Vaults product or the Metaco Flows product, will have their own orchestration, their own policy engines, their own sort of risk and control frameworks. And what we enable you to do is abstract all of those into the single framework that Harmonize can control. So Harmonized security policy is really about a secure, end-to-end secure framework where you can build any policy, have it enforced across any third-party backend. And the use case we're focused on here at the moment is really around the custody. But obviously, custody can expand to other sort of services that will be related to custody, staking, lending, et cetera. Importantly, with a multi-tenant model, as let's say a custodian operating our infrastructure, each of them can have their own vaults, their own sub-custodians that are completely distinct from other entities in the framework. You normalize the data from all these services, have a single accounting layer. So again, you go back to the main proposition here is you only need to integrate your core infrastructure once. If you want to add a new vault, new sub-custodian, they're just connectors into Harmonize. They can come and go, they can change. And as new solutions come in this market, you can be super agile in responding to those market needs or service or product requirements your clients are going to be asking for. Now, importantly, we also now deliver what we call Metaco Trades, which is a full order and execution management system. It connects to 25 plus market venues, so OTC, brokers, and market makers, provides all the advanced order types, the VWAP, TWAP, the iceberg orders, build your own algos. And importantly, the combination now of our Metaco Trades, the algorithmic execution tools we can provide there, the Vaults and the Flows product enables you to automate the settlement process, both on and off exchange, between your basically on-chain accounts and your off-chain accounts that the exchanges may have, or omnibus accounts. You can create completely seamless settlement processes directly, or also interface through a settlement network of your choice. We extend this as well to managing tokens. As I mentioned, the big story is the big opportunity everybody's building for eventually is tokenizing the world, tokenizing the full capital market stack as we know it, and creating transforming unbankable assets into bankable assets. And that will require a smart contract management framework, which we deliver, ability to manage all the major protocols and create specific sort of policy frameworks around specific functions of a smart contract. So that may be about interfacing with DeFi protocols, but also around, you imagine the tokenization process. For example, we have a full module to support anybody that wants to be a designated dealer with DM around the minting, burning, and transfer process. So you can have define explicit governance for each of those. Imagine the corporate actions. All these processes can be defined specific rules around coupons, dividends, etc. Now, important when we talk about this orchestration layer, it's not just about creating manual processes. These processes can be automated at scale. They can be fully based on microservices. Policies can be context dependent. So you can build a framework that defines when the rules change to a separate policies all the way up to a manual exception-based process. So you create a very highly complex system into a very simple system to orchestrate that provides you a single integration into your core infrastructure. Now, importantly, we have a number of partners in infrastructure side, but I just want to focus on IBM here. Our solution is able to be delivered as both a SaaS and an on-prem. So everything we do in the blue box can be delivered as a SaaS. All the let's say the heavy lifting around managing that digital stack, but it's a hybrid model. All the keys sit with the client, and we deliver a number of options around, let's say, keep your own key. So we could be fully compliant with BaFin regulations, for example. So if you're let's say, when I fast go to market, you don't want to manage infrastructure, we have the IBM Cloud Infrastructure Solution. It delivers a FIPS 142 Level 4 HSM, an EAL 5+ certified hyper-protect virtual server, where you can basically manage your keys. You do a key ceremony once, you back them up in smart cards, which are they themselves FIPS 142 Level 3 certified HSMs. And you do not need to touch any bare metal racks. You do not need to manage firmware upgrades. The data center is in Frankfurt. They could provide multi-region, high availability backup. You do not need to manage any tech. That's your tech stack, all managed by IBM. Keys under your full control, and the rest of it provided as a SaaS from Metaco. Alternatively, we still continue to provide the core product, which is non-prem, which can leverage IBM infrastructure. Many of the major institutions we talk to, both in Germany and globally, manage IBM infrastructure, whether it's the Linux One or the IBM Z. We can leverage existing infrastructure you have, or we can purchase new infrastructure to manage this. So fully can leverage existing infrastructure, which can get you a much faster market. So let's put this into a picture, and finally, it'll wrap things up here. So Metaco Harmonize is really this core layer, which gives you all the optionality around how you're going to build that stack. It's important not to think, and I think back to our previous product name, which was Silo. Silos are not a good thing in this space. It's growing exponentially. It's about options around custody. We've seen basically whether it's vendor risk, the ability to be agile, the ability to operate self-custody, sub-custody, different formats of that, hot, cold, hardware, MPC. These are all choices. You don't want to lock yourself into a single solution. You want to maintain maximum optionality in an exponentially growing asset class. Harmonize gives you that optionality, gives you the framework to manage those in a highly scalable way, and delivers the tokens and delivers the trading capability. So I'll wrap up there. Happy to take questions, happy to follow up, and anybody that wants to find out more, my contact details are here. And thank you very much for having me back this year, and look forward to next year again. Thank you very much.
Thank you very much, Seamus Donoghue from Metaco. I learned a lot, and I was happy to welcome you this year again.